I work with people who are preparing to go on a play date with each other. I sort of think of myself as somebody who spent his life in an ordinary, boring corporate job and probably kind of look at entrepreneurs and think, I find that incredibly inspiring.
So your role is what, typically?
Usually, the reason that a lawyer will be approached is because somebody wants to put a solution in place.
Is there like one piece of advice that you'd like to give founders or investors who are listening to this?
There are definitely very aggressive investors who say, I'll put money, but basically I'm going to become the boss. I'm going to own everything. I'm going to control everything. If all an investor is bringing you is money, don't take the money. The trust and confidence of your stakeholder community is like the blood pumping around a living body. If the artery is severed and the trust and confidence bleeds out, death is a natural consequence.
Yeah. Hi everyone, and welcome to Conversations with Lulu. This is a unique episode that aims to shed light at what happens behind closed doors in the MENA startup ecosystem. The global venture capital slump has impacted startups globally and also here in our region, and as a result, a lot of founders found themselves in distressed situations. My guest, Abdallah Mutawi, partner and head of corporate at law firm Taylor Wessing, is no stranger to startups. In fact, he is a prolific angel investor as the chairman and co-founder of Dubai Angel Investors and Saudi Angel Investors. He sits on the boards of several startups, and he is also the co-chair of the legal advisory committee at the Middle East Venture Capital Association. Abdallah is privy to a lot of conversations that most of us would never hear, but he's agreed to come on the show to talk to us about what is happening behind the scenes for the benefit of our listeners. Abdallah, welcome to the show.
Thanks, Lulu.
We meet up all the time, at events, and even though you're a corporate lawyer, I think you have a soft spot for venture capital and startups. Why is that?
Why is that? I have a soft spot for entrepreneurs. And in the sort of startup world, in our region and everywhere, I guess, you find, young people taking the brave step of entrepreneurship. And I find that incredibly inspiring. Yeah. And it's a brave decision by people who could go and take ordinary, boring corporate jobs. I sort of think of myself as somebody who spent his life in an ordinary, boring corporate job and probably kind of look at entrepreneurs and think, I admire you because you're doing something that's brave, and you're trying to innovate and you're trying to create and you're trying to disrupt. Yeah. And so I find that all very exciting.
So you work a lot today with founders, with venture capital funds.
Yeah.
So if you were to describe what you do today to your daughter, I know our kids go to the same school.
Yeah.
So if you had to describe, so if she asked you, what do you do all day? What would you say to her?
What do I do all day? So to a 5-year-old, I guess what I would say is I work with people who are preparing to go on a play date with each other. And I help them to prepare to make sure that they have a good time at the play date and that they don't have any arguments. And if they have any arguments, that we kind of work out how they're going to be solved. Yeah. So yeah, that's probably how I'd explain it.
Okay, you know what they say about there's an Arabic saying about being the judge between two kids. You know that?
No.
Okay, it's in Arabic. It's "Adil Wulad Shana Halu," which means it's very difficult to basically mediate between kids.
Yes, which is why being a lawyer to adults is definitely easier than being an arbiter between arguing kids, that's for sure.
Yeah.
Although in my job, I guess I have seen many, many cases where fully grown adults have the capability of behaving like little children at a play date.
Yeah, I'm sure. I think emotions can run pretty high.
Yeah.
So speaking of that, you published a report last year called the 2023 MENA Venture Law Guide.
Yeah.
And part of that report, you mentioned something. You said, a substantial portion of my time this past year has been spent advising investors and founders on distress situations. Yeah. And then you continue to say, it is easy to slip into emotive reactions and discussions leading to defensiveness and value-destructive behavior. So how are we in 2024? How is it looking?
So can I give you a little bit of context?
Of course.
Yeah. So so we publish every year in my law firm. We do a guide for anybody in the venture ecosystem in the Middle East, and the idea is to kind of give them an insight into legal aspects of what they're doing, whether you're a founder or part of a team building a company, or whether you're an investor. So in our 23 edition, the theme of the 23 edition was distressed situations. Because, there was this tech bubble. I'm sure you've covered it with several people in your podcast. But, in 2021, 22, there was kind of a bubble of overvalued companies, lots of people competing for putting money into companies that weren't necessarily worth what they were valuing them at. And there was kind of a global pullback from the venture asset class globally in, I guess, end of 22, beginning of 23. And so a lot of the companies that I was working with, and some of the companies that I've invested in too, because I'm, as you know, an investor in startups, were starting to face issues where they weren't able to raise cash for one reason or another, and where investors had become much more fixated on what founders were doing with cash, right? So when you're in a sort of bubble period, investors just want to throw money at companies and say, just use this to grow as fast as you can, and don't worry about, whether you're losing or whether you're ever going to break even or become profitable. You see a lot of irrational money being thrown at companies. And there are a couple of global players that were kind of leading the charge on doing that kind of thing.
Here.
Global players,
okay.
mainly out of the US and the Far East.
Okay, so now we're describing the global landscape, not necessarily MENA.
But it was being mirrored here as well.
Okay.
So, in a way, you can kind of say the venture capital asset class, the way in which tech companies are valued, to some degree mirrors what's happening in the tech, in the prices of publicly listed tech companies in the US. So, when there's a sort of dropping of confidence at a global level, it's mirrored in the regional landscape, in the regional environment. So yeah, we were seeing a lot of distressed situations. And I started getting phone calls from either investors or founders that were finding themselves in difficult spots and, asking for help. And obviously, when people put legal agreements in place, they always say that you do your shareholders agreement, you put it in a drawer, and then you never look at it again until a problem happens. And that you're in a problem when somebody's pulling the shareholders agreement out of the drawer, blowing the dust off it and starting to read it.
Yeah.
That's exactly what started happening, last year. So the emotive reactions thing, I guess, is a discussion about how people manage adversity. And there's a big legal dimension to how people manage adversity. What's in your agreements to begin with serves as a map, as a roadmap for how you're going to navigate an adversity situation. And then there are behaviors. There's the behavioral side too. And so in what's, I guess, different in our ecosystem to the global ecosystem is that our venture asset class and venture ecosystem and tech entrepreneurship ecosystem it's younger. It's younger, it's less mature.
And smaller.
Absolutely. Yes, for sure. But the fact that we had never been through a major down cycle in our regional ecosystem means that we hadn't had the opportunity of learning from, the tech bubble of 20 years ago, for example. So people were starting to navigate these issues for the first time. And it was very interesting from a lawyer's perspective, because that's what we do, right? As lawyers, you spend your entire career seeing a stream of management teams come and sitting at your conference room table and telling you about either the problem that they've got or the deal that they want to do, and your role in that situation is to avoid them getting into problems or helping them anticipate what might happen and avoiding them. That's what you're doing in your legal agreements. These same streams of management teams that come and sit at your conference table and tell you what's going on, you observe them. You observe them behaviorally, you observe them emotionally, you observe how they interact with the legal side, which becomes very important when there's a problem. So that's, I guess, what I was talking about.
Yeah. Let's break it down a little bit. So in terms of when you talk about distress in general, what are we talking about exactly?
So, yeah, distress comes in a few different forms, I guess, in the way that I've observed it over the last couple of years. I mean, one is a company that's running out of cash fast and is getting to a point where, the horizon of runway is very short. People start getting very anxious and very worried and not knowing what to do in that situation. Others get into other distress situations, like a company that wasn't expecting to become technically a bankrupt or insolvent company, suddenly becoming a technically bankrupt or insolvent company.
What is technically bankrupt?
Good question. So there are two tests for what an insolvent company is. Insolvency is the sort of technical expression. So you're either insolvent because you don't have enough cash or cash flow to meet your debts as they fall due, which we would describe as cash flow insolvency, or balance sheet insolvency, where your net liabilities are greater than your net assets. In either of those situations, you're considered to be an insolvent company.
Okay. And it's an issue because typically those companies would be funded by VC.
Yeah.
And VC would be giving them that cash to meet those liabilities or meet those responsibilities that they have. But then the issue happens when the VC money stops coming, right?
Correct.
And then they realize that they're unable to meet their...
Correct. And in this ecosystem, it's expected in the venture asset class, it's expected that a company will take money from an investor and use that money to create value. Actually, the whole underpinnings of the convertible instrument is that you give the money to a founder, the founder uses the money to create value, and then at the end of spending that money, usually the founder has created enough value that somebody will come along and say, right, I'm now going to give you some more money and I'm going to value your company. And that's going to convert the investment of the previous investor into shares at today's price rather than last year's price. It has been expected historically that founders will spend money on developing the product, getting the go-to-market strategy up and running, acquiring customers. And, a lot of these companies are rarely profitable.
Yes.
And, the famous kind of global stories of Amazon and Uber and companies that were losing money for years and years as they were building their audiences of tens and hundreds of millions of eyeballs was kind of getting up and running. So venture investors.
Startups are typically what we... The reference that we always say, they're burning cash, basically, when they're building value, when they're building those products, hiring more people, expanding into new markets and so on. And then VC will come and, give the startups that money so that they can build. Okay, so you said the first type of distress is basically them running out of cash. No, I'm assuming that it's a problem because they are bigger companies, right? So you're not talking about the startup that has just gotten their first check from an angel investor and they're running out of cash.
Yeah, exactly. I mean, the more is at stake, the more the stress, I would say, and the anxiety, and then the behaviors that come with that.
So what happens so it's a big company, it's running out of cash. Who approaches you usually, the investors or the founder?
So look, usually the reason that a lawyer will be approached is because somebody wants to put a solution in place. And so, it varies on whether it's a founder or an investor. Typically it's an investor, actually, who will come to you and say, look, we have this company, this is going on. We need to get some money into the company, otherwise the company is going to run out. And we want you to help us kind of put a structure in place or put an investment in place that helps the company survive, but that kind of rewards the person putting the new money for the fact that they're coming and taking a risk on a company that's clearly running out of cash, which is obviously perceived as a negative. And, there are the connotations around why is the company running out of cash, rather than having investors just doubling down. I mean, there are companies in our region and globally where investors are not only lining up to give the company money, even if the company's not making money, but where sometimes they're competing with each other to make that investment or to lock each other out of making that investment. So some companies are extremely attractive for investors, and how they're performing financially doesn't impact the investor confidence. And some companies, the investor's confidence is impacted.
So they come to you and they say, we need to raise money.
Exactly.
So your role is what typically?
So, sometimes they want ideas. How should we do this? Here is the problem. What's the solution? And sometimes they come and say, look, we've got a company that's in this situation. This is the solution that we want to implement. Does it work? I mean, I had a call with the board just 3-4 days ago with a company that is pretty much running out of money. It's a mature company. It's raised post-Series C.
Post-Series C means, just for our audiences, so they've raised what, 20, 30, 40 million, 50 million probably, when you talk about post-Series C?
Yeah, they've raised tens of millions of dollars for sure.
Yeah.
Some companies are starting to raise hundreds of millions of dollars at that stage. But yeah, a company that's raised tens of millions of dollars, it's built out a big customer base, and something is going wrong. And it could be that the product market fit still hasn't been completely proven, or that the business model and the unit economics still haven't fully proven themselves. People have been, investing in an idea, hoping that this product that's out there in the market is going to gain the kind of traction that's required ultimately to kind of enable it to scale and become profitable. And sometimes companies, I invested in a company that has just recently closed down because its entire product was made redundant by the rapid emergence of AI and large language model players, and where even if they had product market fit 3 years ago, today they have zero product market fit because the problem they were solving is being solved in a different way by LLMs. So yeah, lots of different reasons why these things happen. But what it comes down to is investor confidence. So the lawyer role is, how do I help you document new money coming into a company in a way that, as I said, rewards the person putting money today for taking that risk, for stepping up. And usually the investor wants a lot more than they would have had they invested when the company was less distressed.
And this is an existing investor, or this is a new investor usually?
Yeah, good question. So more often than not, it's an existing investor.
Okay.
And there's a reason for that. If you've already put money in a company that is at risk of going to zero, then your decision at that point is, should I throw good money after bad? In other words, if I put money now, am I kissing goodbye to it? Or if I put money now, is that money going to help salvage
and turn things
all the money
around
that I've already put in?
Yeah.
So typically it's an existing investor or a group of existing investors.
Wow.
Yeah.
That's a tough decision to make.
Yeah, it is. But look, true venture capitalists, as opposed to private equity people or people kind of getting into venture for the first time, they understand the nature of entrepreneurship.
Yeah.
They understand the nature of disruption in tech. They understand sometimes, something isn't quite how you thought it was going to be, but that there's an opportunity to pivot, to do something differently, to restructure the business, to remove the management, put new management. That's a conversation which rarely happens in this region. We can talk about that later. But there are often ways of saving a company if the company actually does something different. So when an investor comes forward and says, you know what, I'm going to put more money in a company I've already invested in that is distressed, a good investor is the one that comes and says, but I want things to be done differently. Some investors just come and say, yeah, I'll do it. But what I want is, I want really cheap shares, and I want, outsized liquidation preferences, but I'm not going to force the founders, or I'm not going to work with the team to do something completely differently, whether it's in product, whether it's in unit economics, whether it's in, management.
So the money is one aspect of it, right? But there's a lot of change that needs to happen in that scenario.
Yeah.
And sometimes you're saying the investor is only interested in getting more shares in the company, but not necessarily doing the work to actually help that company.
That's right.
Pivot or do
right.
what it needs to do.
That's right.
Is it normal to ask for more if you are putting in money in such a situation? Wouldn't you say that you're already an investor in this company? Why would you wanna put them in a situation where they have to really give you, I'm assuming, a lot extra? Is that the norm?
Yeah, look, it's a good question. Let's take an example cap table. Okay, you've got maybe 30 angel investors on a cap table. And you have, say, 3 or 4 Series A investors, plus all the angels who converted to Series A when the Series A was done. And then maybe you have a Series B investor, usually a different lead investor at Series B, but the Series A investor would have probably put some money then as well. So by this point, you've got a cap table of, say, 40, 50 people, all of whom are in different categories and different levels of sophistication with different mindsets and different attitudes to what's happening to your company at that moment in time. Not every one of those 50 people is going to want to step up and put money. Mm-hmm. If your first option as a founder is to go to every one of your investors and say, look, here's the situation of the company. We're not performing as we were expected, or something's going wrong. We need a few $1 million to kind of help us do X, whatever X is. Mm-hmm. The chances are that 90% of those people will not want to put more money, particularly angels. Angels put a $25,000 or a $50,000 check. Yeah. And then that's it. They're interested in building bigger portfolios and just investing in rocket ships. And so they don't usually step up in a moment like that. So the person who does step up is saying, look, I'm taking this responsibility and this risk on. Mm-hmm. My reward for that should be outsized to the person who is now just a passenger on the ship. And so that's usually what's happening. They're kind of saying, I want a bigger seat at the table. Mm-hmm. I want more risk, more downside protection. So if the company ends up going south, I want to get my money back first. I mean, that makes complete sense. So the way in which that's done and the market practices around that are, different in different regions. Again, the US has seen a lot more of these up and down cycles. There's more of an established market practice around how these things are done. Yeah. That doesn't mean that investors in the US are all more founder friendly or less predatory. There are definitely very aggressive investors who say, I'll put money, but basically I'm going to become the boss. I'm going to own everything. I'm going to control everything. So it depends, Kaman, the flavor of the investor and their attitude. But yeah, so that's typically what's going on here, is that people are asking for more protection as a reward for taking on that risk. I mean, that's the simplest kind of way of putting it.
Okay.
Yeah.
And in that scenario, are they valuing the company lower? So there's also is it a down round basically where they get more, obviously more shares for their investment?
Exactly. And look, I mean, a down round is not. Yeah, look, a down round has very negative connotations. As soon as people hear the word down round, they start running. Yeah,
because you said our venture capital ecosystem is slightly nascent, right? It's been 10 years, and people are used to seeing those investments appreciate. Every year they have to, or 18 months or so, when there's a new injection of capital, those valuations are going up, and all of a sudden, somebody talks about a down round.
Yeah. Yeah. And I mean, look, the definition of a down round is where a company sells shares at a lower price per share than they sold shares previously. That's basically it. Yeah. And yes, I mean, in distress situations, that's what's going to end up happening. Yeah. You're going to have to do that. Of course, neither investors nor founders want to be seen to be doing a down round. And so what has happened over the last, what I've observed over the last 2 or 3 years, is that both investors and founders are very good at coming up with strategies for making a down round look like something else.
Such as
a flat round, for example.
What's a flat round?
So in other words, so when you're selling a share with a price, then you're pricing the share at the moment of selling the share, which is, we call it a priced equity round. So one common method is to say, I'm not going to raise a priced equity round at this moment in time. I'm going to issue a convertible note, and the convertible isn't going to convert until some point in the future. Okay. And therefore it doesn't price the company today. Mm-hmm. Of course, convertibles come with valuation caps, which some investors or the broader market might regard as being, a valuation of sort. Yeah. So, but what might happen is an investor might agree, for example, to have a higher cap, but to find another way of getting an outsized downside protection, like a double or a triple liquidation preference. Okay.
So liquidation preference, also for those who are listening, it's basically if the company shuts down or also if there's a sale of the company.
Yes, exactly. Yeah.
Okay. Yeah. You get your money first.
Yes.
And 3 times in that case, if it's 3 times liquidation.
2 times, 3 times, 1.5 times.
What you invested.
That's right.
Yeah.
And then you have the concept of participating and non-participating.
Okay.
Right. So the market standard the market standard is a 1 times non-participating liquidation preference. So in the worst case scenario, if there's only enough cash, if there isn't enough cash to distribute to the entire waterfall on the cap table, then I will get 1 times what I put in.
Mm-hmm.
And that's it. That's
this is
my
participating?
money. That's non-participating.
Okay.
Participating is I'll get 1 times what I put in. And then once that's been done, I'll then participate pro rata in the remaining proceeds.
Okay.
So the market standard is 1 times non-participating. And I've seen term sheets in the last year or two with 2 and 2.5 and 3x.
Wow.
Even participating. So, these are quite aggressive. I've also seen investors pull this move multiple times, and they're the more aggressive investors in the market who, for example, know that the company is potentially thinking about a sale.
Mm-hmm.
Now, a company may be looking at doing a sale, an M&A, in order to generate an exit, because everybody has come to a consensus that, you know what, let's forget about the unicorn rocket ship. Let's just get out of this now. Let's sell the company. This is worth something to somebody. So not a fire sale, but it's like, this is a good moment to sell. Mm-hmm. And I've seen a couple of aggressive investors in the market say to a founder, look, you're running out of cash, but you want to sell the company. In order to kind of preserve your negotiating leverage and give you some comfort, you probably ought to extend your runway by 6 months. Mm-hmm. So why don't I give you 6 months of runway?
Which is basically cash to pay for operations.
Which is cash to basically maintain the company and the operations for a good period, to allow you the comfort and the space to negotiate your M&A deal without being under pressure to have to sell at a fire sale price. But when I give you that money, I'm going to put in a 3 times or a 2 times liquidation preference. And the reason they're doing that is because they want to get double what they're putting today out of the sale proceeds. So what they're kind of technically doing is jumping the queue or putting themselves higher in the queue. Mm. And so I see that happening, and it's usually an existing investor who's invested in the company once or twice or 3 times, who might say to a founder, yeah, take this money, take it, because they feel confident that the M&A can be done, and that they, as an investor, may even be able to play an influential role. Usually they have a board seat. Usually they've got experience. Usually they're helping the founder navigate the M&A process. So they see it as an opportunity. So I've seen that a few times. It's an interesting one because a lot of founders don't see that coming.
Okay.
Yeah. I mean, I'm working with a founder right now who is in exactly that situation and, accepted cash to extend runway. And the investor thought that it was going to result in an M&A and that they were going to basically get double the cash. And look, I mean, the other thing to remember is that people have different incentives when they're sitting on an investment. An angel is somebody who usually wants to support an entrepreneur and wants to put a ticket in a lottery where hopefully they'll get 100 times back.
Yeah.
1 in every 10 investments or something like that. A venture capital fund is a professional investor managing a collective investment scheme that has promised its LPs, a projected rate of return. They want to outperform. They want to deliver a return as quickly as possible. The faster they can show returns in their fund or even distribute capital back to their LPs, the better the chance they'll have of raising the next fund. There's a lot of psychology that goes into how I'm behaving and what I'm thinking about.
Yeah.
So anyone who can put themselves in a better position, will think that way. Mm. Another one that I see quite often, and it's very smart, by the way, is a VC that comes into an investment where they're doing, for example, a Series B investment. And let's say the price per share for the company is $10 and the Series A investors paid $2. Mm-hmm. So if the investor comes in and says, I'll put my $10 million check at $10 a share, but find me some Series A investors who want to exit, and I'll go and offer those people $5. So $5 to the Series A investor is a nice $3 profit on what he paid for his share, but it lowers the average price per share for the Series B investor coming in, which means that the day the deal closes, he's already got a book return on the money because the share today is worth $10, but I got it for $8. So the day after I closed my deal, I'm already 20% up.
Yeah. But that's sort of healthy, right? I mean, what you're describing is called secondaries, right? So you come in, you can buy out some of the existing investors, or maybe some of the management team or the executive team.
Yeah.
Obviously, the company is doing well, and then you also make an equity investment at the same time. But
Absolutely.
that's quite smart, actually.
Yeah, it's very smart. I mean, I'm working with the region's first secondaries fund at the moment, which is about to launch, and there are a lot of people out there who want to sell.
I'm
shares.
sure.
Yeah.
I mean, if you look at the earlier funds, right, the ones that were launched around vintage of 2006, 2007, like these guys need to exit.
Yeah, absolutely.
And make their returns.
Yeah, so I mean, the one that I'm involved in, Debate Angel Investors, is 2016 vintage. And we have some companies in our portfolio that are 2017, 2018 investments. So 6 years later, it would be great to get an exit on some of them.
Did I say 6 and 7, by the way? I meant 16, 17.
There you go. Yeah.
Sorry.
Yeah. But yeah, I mean, angels, and a lot of angels get into it, of course, dreaming about the rocket ship company where they invest today, and in 2 years from now, it's 100x, which is a Silicon Valley, unicorn story. A unicorn being a mythical creature that doesn't exist, right? So
it's interesting you say that, because obviously I do angel invest, quite a bit, and it's funny that a lot of the people with me, they're usually, so when are we gonna make that 100x? It's like, okay, maybe more likely 2 or 3 or 10 if you're really lucky. 100x. But by the way, I heard something on a podcast once, and I think it's very interesting. People treat the public markets and the private markets completely differently. So if you are, buying stocks in Apple, it's completely normal for you, for the price to go up and down, and you're fine with buying the price at a lower rate or a higher rate, and dollar cost averaging and all of that stuff. But in the private markets, the value of the company has to always keep going up.
Yeah.
And if it goes down for any reason, it's a disaster.
Yeah.
But it's normal.
Yeah, it's normal. Look, I mean, that psychology is understandable, because the thing about public markets is liquidity.
Right? Yeah, absolutely.
These are totally tradable.
Yeah, you can sell it.
Yeah, you can sell it. So you can make a decision, and just the safety of knowing that you can exit at a point of your choosing, or that you can hold on and the likely price will be rebound. The other thing about public markets is you can study their historical performance, and that there's volatility, but that ultimately there are investing strategies that allow you to mitigate volatility in liquid, securities. Whereas in private, when the value goes down, the implication is that the liquidity reduces, or the possibility of liquidity in the future reduces.
You're right.
It's not necessarily true, but
but I mean, obviously the liquidity plays a big role. You can't really exit whenever you want. You can't say, I've had enough, I want out now. It doesn't work that way.
It's all about psychology at the end of the day.
Yeah. So going back to distress.
Yeah.
So you said one of the things is obviously these companies running out of cash. You mentioned something else, which is the management, basically, or the founding team.
Yes.
You said that we don't really have a discussion here about replacing the founders when the company is mature. So can you tell us more about that?
Definitely. Yeah.
And why do you think that is?
Look, I mean, entrepreneurship in our region has gone through some big positive evolutionary steps in the last 10 years. The idea about a startup is that it's a company that is out there doing something daring and disruptive, and that has a high chance of failing. Failing in our region has never been, wasn't historically something that was easily accepted. That's why in our cultures, and I don't mean to be sort of too generalistic about this, but it's true, in our cultures, our parents and grandparents always push us towards engineering and medicine and law and these kind of like secure professions where you can always monetize your skill in a way that's very linear and non-exponential in terms of value creation. So it's low risk, but low return ultimately. With entrepreneurship, the idea that somebody might go out and, put capital into an endeavor that might fail isn't something that's was historically widely accepted in the region. Trading is different, right? Being an entrepreneur who opens a restaurant or a textiles business or a factory that makes widgets is different, because as long as you can establish a market and get out and sell and it's an obvious product, it's okay. And there's lots of that in the Middle East. But doing something that is risky because it's disruptive and may or may not gain traction wasn't. So now our region has gone through a really good cultural evolution where it's no longer regarded as being a negative thing or as negative a thing if a company fails. People have seen the success stories of disruptive companies that come and create enormous value and go from being tiny startups to being enormous companies. And there are many examples in the region. And people find that inspiring. And the parental and grandparental generation says, okay, I get it. But what was the question?
The founders, replacing the founders.
Yes. But so management teams and where management teams fit in and the cultural view around that hasn't quite evolved as fast. And so, and a lot of the fault for this sits with founders themselves. And a lot of it sits with investors, right? I mean, it's a truism. And I say this to my, friends and peers who angel invest, for example, and I say it to founders all the time, if all an investor is bringing you is money, don't take the money. If that's all they're giving you is money, don't take the money. Like you should be selecting investors who are going to be creating value for you. And part of the value is mentorship and guidance and giving you the benefit of their experience. The great thing about angels is that we typically tend to be older people that have navigated, situations a few times and have the benefit of some kind of wisdom that we can help people with. So understanding when a management team isn't suited for the next phase of a company's life is quite an important thing to have, and not just in a distressed situation, by the way. I mean, you can be somebody who came up with a beautiful idea for an amazing disruptive product. You built it, you launched it, you started to get traction with it, but you're not the person who knows how to take it to the next level. And so, again, if you kind of look to the Silicon Valley experience, there are many, many, many examples of founders who developed a beautiful product and got it into the market and established product market fit, who then decided, or who an investor influenced to say, now is the moment to find a CEO who has a track record of taking a product similar to this and driving it to scale and to growth and to create really great value for the company. I don't see that in this region. I don't see investors having that conversation. There's, we have
even when it's clearly, even when there's a clear need for it, you feel like,
look, we are not as aggressive a business culture as the American business culture. We're nowhere near as aggressive. We do have concepts of preserving face and pride and people not losing face. So you find the same, in many parts of the Orient, the Eastern world, let's put it. So I mean, that's maybe part of the reason that, an investor doesn't want to say that directly to a founder. And you may find lots of founders who decide that their product is their company and that's their identity. And that stepping down from a role because they're not really the right person for that role at that moment in time is something that they're willing to countenance. I see it all the time. So it's something that needs to change in the region. Investors need to sit down with founders, or founders need to come to investors and say, you know what, I think the time is right for me to become head of product or chairman or something, or chairperson, and for us to hire a professional CEO who can take this company forward.
I think it'll be good to have someone thinking about it now on the podcast who's been through that experience, maybe as a founder who's stepped out of the CEO role and done a different role in the company. Because I think people need to hear those stories and know that, it's okay. It doesn't mean that I failed as a founder if I don't have the CEO role or like the C-suite role if it's several founders. So I think maybe we need to know that it's okay.
Yeah, absolutely. Look, I've worked with a couple of founders or companies where it has happened.
Okay.
But it's usually happened because of a distressed situation. It's usually been investor driven, and the best decisions are not necessarily taken in those scenarios. But one of them, actually, the founder himself, and it was a great product, very innovative, very much product market fit, lots of customers. The company's actually doing quite well, but the founder just wasn't up to, taking the company through that next stage of growth. The investors recognized it. The founder tried, actually quite hard to kind of grow into that role, but ultimately turned around and said, you know what, they're right. I'm fine. I'm going to happy to step away from this role.
Yeah.
And then the investors put somebody in that role with a track record who they had confidence in. And actually investors having confidence in the management team is a big part of the success of the company, because if they have confidence, then they're more likely to support the business, not just with cash, but with attention and with support.
Yeah. So let's talk a little bit about like some of those failures, let's say, that happened where also there was a change of management involved. And I think one example comes to mind is Fetchr. Obviously, that company shut down. So for our audience, if you're not familiar with Fetchr, it was launched in November of 2012 by Idris Rifai and Joy Ajlouni. And then basically it helped local merchants and global brands build, launch, and grow profitable e-commerce businesses. Basically, it was a delivery service, was solving for the no address problems, and they had a good technology that merchants could use and then deliver their products to their customers. So in 2015, they raised $11 million, which was led by a San Francisco investor called NEA. And then in 2017, they raised $41 million, which was their Series B, which valued the company at over $300 million, and had a lot of the, let's say, local investors come in at the time. Also, NEA led that round, but then they had Beko Capital, Majid Futem, Ra'ad Ventures, Venture Souk, and others. And then the company was quite large at the time, 1,500 employees across 9 offices in the region. Then in 2019, Joy, one of the co-founders, left the company. Then there was an emergency fundraising of $10 million. And then things sort of started going downhill. There was a restructure. And then eventually the company shut down in 2021.
Yeah.
So for the purposes of educating our audiences and people who might be in similar situations, maybe you can, I know you were involved in the company. What happened basically? What went wrong that you think could have not gone wrong in hindsight?
So look, I mean, just to clarify, I wasn't really involved with the company until the last crisis happened, the restructuring.
Okay.
What I do know is that Series B, I think, was the largest Series B ever to happen in the region. It was, the company was pushing a lot of boundaries and doing very well. I think the crisis happened because 2 of the world's biggest investors were involved in or looking at doing the Series C round. And I don't know exactly what the reason was, but in the end, the Series C round didn't happen, and the company got to that cash crunch position.
Which is how we started the conversation.
Which is how we started the conversation.
Big company running out of cash.
I mean, it happens to a lot of companies, actually, even great companies that are generating a lot of revenue, that have a lot of employees, that are solving real problems.
Yeah.
And they're on the road to growth. And it does happen. I've seen it happen multiple times, actually, where the company is very close to raising enough capital to really turbo boost the next stage of growth. Suddenly the investor pulls out, or the investors pull out, and the company has 1 month of cash left.
Yeah.
And it's a completely different conversation. So when I got involved with this company, it was with the small group of turnaround investors that came to basically take the turnaround strategy to the existing investors of the company and say, we've got a plan. If you would like to back it, here's what our plan is. And it was a really good team of people with very relevant backgrounds. There was a former CEO of Aramex. There was a former CEO of Majid Futem, which was an investor in the company. And then people from the corporate finance and the world of logistics, formed this little consortium. They brought some of their own personal cash. And they went to the existing investors, mainly the Series B investors, and said, look, we can put together a structure that, which I helped them with, of course, that will enable us to put money into the company that rewards you for stepping up and putting money in the company that allows it to survive. But in order for the company to survive, it requires a complete restructure and a change of management and a change of strategy and then a change of approach. And so we did it. We actually did what is known as a pay-to-play financing. All of the big investors at the Series B round, or most of them, actually participated. The most complex aspect of doing a deal like that, particularly for a company that's raised capital a couple of times, is that, and you know, I don't want to get too deep into the weeds of shareholders agreement and articles of association and all of that, but it's important because this is one of the legal dimensions, is that each time you raise capital and issue preferred shares, you create a new class of shares, the new class of preferred shares. Typically speaking, to do a deal like this, like a major down round, in this particular case, it kind of reset the clock on the company valuation. It valued it at pretty much zero. To do that, you need the consent of each of the classes of shares. So if you are, if it's a company that requires the ordinary share class to approve, usually it's a simple majority of each class, then you've got to persuade 50% plus one of the ordinary and 50 plus one of the A's. Sometimes the ordinaries don't have that vote. It depends. And
the ordinaries are the founders, basically, and the management team,
correct,
and maybe the angel investors.
Well, angel investors, friends and family might have ordinary.
Okay,
but
so
angels,
these are common shares.
Correct, yeah. Common shares. But typically the angel investors who will have invested on a convertible should convert to the next issued class of preferred shares. So an angel should become a Series A preferred shareholder. So let's say you don't need the ordinaries. Let's say you need the permission of the A's and the B's. Well, you've got to get the permission of the A's and the B's, and that means a majority. Sometimes it's a simple majority. Sometimes it's higher than a simple majority. So if you're going to the A investors, the A class shares, and saying, look, here's the deal on the table, you're welcome to participate, but the chances are the majority of them are not going to want to participate.
This is the pay to play.
That's right. Then they have to accept a deal in which their shares are either wiped out or demoted and redesignated as ordinary, or both, you know, essentially crammed out of the company. And so the stakeholder management side of that is tricky. If you're the management team, you may not like it because the impact on the management team is going to be quite heavy as well. Not just the management team, but actually all the employees. You're being wiped out too, right? Because potentially you're being wiped out too.
Unless you're being incentivized again with the new investors.
Correct. Absolutely. So that's, again, that's another one of these sort of, how do you manage these distressed situations? And a lot of investors don't necessarily think about that. But yeah, I mean, if you've got your salesperson or your iOS engineer who's been given this little ESOP share that they're hoping one day is going to be worth $1 million. Suddenly their shares are worth nothing and they're being paid less than the market price for what they do. Then the chances are you're going to lose them. If you lose the team, then
you've lost the company.
You've kind of lost the company. So there's a lot of stakeholder management. So in the Fetchr case, the deal was done. And
so you managed to convince everybody that this is the best deal for the business.
Correct. This group basically brought a new strategy, and they brought the new strategy to the investors and said, here it is. And the investors backed it and they put money into the company and the company survived. And then it's like I hate to say this, but you know, these, the guy who died on his yacht the other day.
In the UK?
In the Mediterranean, you know, in this freak accident.
He's a British guy, right?
That's right. Yeah. And, you know, you kind of go through all this adversity, then you have this big legal case, and then you win your legal case, and then you go on a yacht and it gets hit by a storm and it sinks and you die. Or his partner, who on the very same day went for a run and got hit by a car and killed, right? So the same thing happened to Fetchr, because there's the company, it survived, it's up and running. The new management team are kind of doing the restructure and the new strategy, and then the company gets hit with a penalty by the tax authority in Saudi Arabia.
$100 million.
Something like that.
I checked it, but it was $100 million.
And you know, I mean, nobody really understood where that came from. It was like a really arbitrary, grossly unfair penalty to be imposed on the company for something that wasn't even established as having been done wrong by the company. There was a kind of allegation, I think, that, we don't think you filed your VAT returns correctly or something along those lines. The potential value of the misreporting was in the single digits of millions of dollars, $2-3 million, something like that. But the penalty on the company was like 100 million.
Yeah.
So the company went from being solvent to being like very, very badly insolvent in a heartbeat. And that was the end of Fetchr. But, it was a very innovative deal for the region. It was the first pay-to-play turnaround of a, distressed venture-backed company. It was a mature venture-backed company. It had enjoyed quite a bit of success in terms of growth and getting its product into the market. So
Abdallah, just give us 1 minute on the pay-to-play again. Like, what does it entail?
Look, there are many flavors of pay-to-play, many ways of doing a pay-to-play. But the pay-to-play as a concept is, there's a deal on the table. If you participate in this financing, then you will be treated in one way, which is in a way that at least preserves the rights that you have in the company, if not significantly enhances them. And that could be in terms of legal rights, but it could be in terms of value as well. So if you were a Series B investor in Fetchr and you had paid whatever the price per share was at Series B, the pay-to-play was offering you the shares at a $1 pre-money valuation. So you're resetting the clock, which means that when you put your money, you're essentially getting a much bigger equity stake in the company than you would have possibly dreamed of having as an A and a B investor.
Okay.
So essentially you're getting economic value, outsized economic value that way. So what you're doing is effectively investing in a different type of company. It's more like a private equity investment.
Okay.
There's a team, they're going to do a turnaround. The turnaround is going to create value. My equity stake is going to be a much bigger equity stake, and we'll get some kind of an exit. But my exit will be on a much bigger equity stake than my venture investment.
Yeah.
The other type of protection that you would get is a preference, and it would put you ahead of, anybody who doesn't participate. So I did another deal last year, with a company that I'm not going to name because it's still alive. But in that case, we didn't wipe out the earlier investors, but we did demote their shares from preferred to ordinary.
Okay.
Yeah. Or common. And I mean, it was even slightly more complicated than that because we created a sort of mezzanine level of preferred shares, depending on, various kind of conditions associated with the financing. But pay to play is, if you participate with cash, then essentially you kind of step up into the higher tier. And if you don't participate, in the worst case scenario, you get completely wiped out. And in the best case scenario, you become a more passive and lower priority, passenger on the ship, effectively.
Okay. So typically, I would assume it will be the angel investors maybe that might not put additional money that might get wiped out because they don't have funds. And
typically,
On one thing on your end, so as somebody who is witnessing all of that, so there's. So we all know that you need to engage a lawyer as a founder or anyone in business. Really, you need to have a lawyer. And I think people maybe tend to not do this initially and tend to push it later on. But I guess at a price. But it is one thing to, I think, put together like a really solid legal agreement. But it's another thing, I guess, for you to enforce it, right? And figure out like, how do you manage the emotions and so on. So how does it feel to you when you're in these types of situations? I mean, you probably know everybody on both sides of the table.
Yeah. Yeah. I mean, in this market, that's true. And obviously because of, being an investor, I obviously know the vast majority of investors.
Yeah, I mean, you've invested in over like 30 businesses, I think?
More. I think I've probably invested in 60, 65 actually.
Okay.
I mean, Debate Angel Investors is one vehicle that I've invested through, but I've also personally invested in a lot of companies over now about 15 years. So, so I mean, in the Middle East, I definitely know most of the investors that are professionally investing.
Yeah.
So if you're on the founder side, it's quite common to know at least half the board and half the cap table.
Yeah.
In fact, every time I get a new mandate and I get a new cap table, it's the most fun part. It's like looking down the cap table and counting how many people I know. And it's fun, and it gives you an insight into what people are doing. And of course, I'm like a Catholic priest, that information has to stay, deeply locked inside. But you see it, you obviously see a lot of people that in the market, and you start seeing that some people naturally behave in a certain way and other people naturally behave in another way. I mean, shareholder and cap table dynamics is one thing, board dynamics is another. And of course, by the time a company has raised priced capital 2 or 3 times, the board of directors is made up of a mix of management team and investors. So yeah, those are the most interesting.
So how does it feel to you when you're navigating those types of situation?
Look, I mean, one of the reasons I get called into a lot of these situations is because of being familiar to the people involved. I mean, actually, right now, I think I probably have 3 or 4 mandates right now where the initial approach came from an investor, even though they recommended to the founder that the founder appoint us as their legal counsel, because the investor says, look, let's work with this guy because, we all know him. We know, that he knows what we're doing. Yeah. We trust him to be a sort of, an honest broker, I guess is the expression. And so it's comfortable dealing with those situations because you have trust of people, even if they're not on the same side. I mean, ultimately, when you're advising a company, you are advising the company, and you're advising the company what to do in its own best interest. And of course, the board's duty is to act in the best interest of the company.
Yeah. But that doesn't happen all the time, does it?
It doesn't.
And you have people, right? And people have emotions, have interests.
But you know what? I one of the things that I do enjoy seeing, and it does happen more often than you might expect, is the investor will say to the founder, get Abdallah on as your company counsel. And it's okay, we're comfortable with that. We know that he may advise you to do things that aren't necessarily in our interest as a shareholder, but ultimately that are in the interest of the company. And they may not always like the advice that you give to the founder or the company, and they may push back and they'll use their own lawyers to do that. But they also kind of sense that you're a sensible person to have at the table, and that ultimately you'll be able to navigate to find a sort of outcome or a strategy that's acceptable.
So you haven't been in a situation where emotions were...
No, I have. Plenty.
Okay.
Plenty.
Give us the meat, Abdallah.
Yeah, look, I mean, I have a client where they were given money by an investor who was expecting to receive a solid payday because that investor snuck a, very, very healthy liquidation preference into a convertible note in anticipation of an M&A. The M&A didn't happen. The investor was sore. The investor and the founder had a personality clash, an ego clash. Suddenly the board and the dynamics of the board became, very fractious and very personal and really not focused on the best interest of the company. And then the investor at some point said, you know what, I want my money back on their convertible that they had put this like aggressive liquidation preference in. And that put the company in a position where it went from being solvent to insolvent in a heartbeat.
Oh, wow.
Yeah. So I'll tell you how that situation played out. An investor comes to a company that it's already put millions of dollars into, okay, and says, you know what, I want my note to be repaid.
Yeah.
Knowing full well the company doesn't have the cash, and knowing full well that essentially makes the company technically an insolvent company. Now, that's a big card to play. It's a very aggressive card to play. And it's not a very smart card to play if you're on the other side of that card and you're calm and collected and smart and analyzing the situation rationally. Of course, if you're the founder and an investor says to you, I'm pulling this move on you, and this move basically is bankrupting your company, the chances are, unless you're, again, old, wise, and very seasoned, you're going to go into headless chicken mode because you're going to be thinking, oh my God.
As a founder,
Yeah, as a founder.
By the way, just a side note on this.
Yeah.
So the convertible note, again, just to explain it to everybody, it's basically I'm an investor. I'm giving you, the founder, money, but it's kind of a loan. And I have the right to ask for my money back, which typically never happens.
Correct.
With interest.
Correct.
Or my money converts into shares in your company.
Absolutely right.
So what you're describing here is that I've given you $5 million or whatever, and then I come to you and say, I don't like you, I want my money back.
Correct.
And then obviously as a startup, you don't have that cash.
Correct. You don't have that cash. So you're in a technical insolvency situation now.
And then you go in headless chicken mode.
Yeah, I mean, and I don't mean that to be rude at all. I mean, that's a very stressful situation.
It is a stressful
for
situation,
a founder.
of course. Yes.
Imagine.
Yeah.
So the role that I can play in that situation, and the role that I have played in this particular situation, is to sort of sit the founder down, maybe even to sit the entire board down, including the investor that played this very aggressive card, and say, guys, let's just look at this dispassionately. Really? Are you really going to play that card? I mean, you've already put millions of dollars into this company. Now you're going to make it insolvent? Do you know where you stand in the overall scheme of things? You know, you're an equity, a shareholder in all of your shares, and you're an unsecured creditor in as far as your note is concerned. In a tech company that doesn't have millions of dollars of saleable assets, I mean, your assets are your customers at the end of the day.
Yeah.
Or your advertising revenue, or a combination of those things. So by playing this card, you're basically damaging yourself. And in fact, if you're a VC fund, you have a duty to your LPs not to do things that destroy the value of your own investments. So I don't even think you have the authority to play this card that you're playing. There's just ego at work here. So let's step back from this and try and work out whether there's a solution that brings everybody to the table, where you can have a conversation about what should happen next. You know, you're not happy with something that has happened. You decided to play this card. Forget about this card. Withdraw the card. Pull it back. Do something else. You know that's the right thing to do for you, for the company, for everybody involved. And of course, there's a whole legal framework around that conversation, understanding the insolvency laws, understanding the company's laws, understanding the shareholders agreement, being able to remind everybody very calmly and politely what their rights are and what their rights aren't. I'll be honest with you. I mean, these are the mandates that I enjoy the most, because, you know, doing a Series A financing for a founder, you know, I love those two because the founder is raising capital for a company and growing and disrupting. But the crisis management part, I enjoy a lot more because it's challenging. The stakes are high.
Yeah.
And you have the opportunity of getting irrational minds to just calm down a little bit and work out whether or not there's a path forward that is actually for the benefit of everybody.
Yeah. That's probably a big part of your job is psychology.
Yeah, absolutely.
Like to figure out which buttons to push or
psychology and strategic communications.
Yeah.
How you communicate, what you choose to say, how you choose to phrase something, how you sequence communications, who you speak to first, or who you advise the founder to speak to first, or there's so much that of our job in these kind of distress situations or crisis situations that are to do with communication and how you communicate, and the order in which you do it, and the playing on exactly the psychology, as you say, of the parties. Anyway,
in our ecosystem, obviously, everybody talks about, you don't have a big amount of exits. I mean, getting your money back as an investor is quite the challenge. So that definitely puts more stress, I guess, on everybody as well, because it's not a market where you have a lot of exit and you get that money back, the liquidity basically.
No, that's right.
That definitely also makes the situations even more stressful. There's also one more thing that I wanted to touch on in terms of due diligence. So you typically, when you're investing in a company early, you don't look too much into the details of the company, right? And then the bigger the check size, ideally, the more time you spend on this company.
Yeah.
Do you find that maybe some of those distress situations are due to like a lack of diligence? So people don't do their homework the way they're meant to?
Good question. Look, diligence particularly in early stage investing. So now I guess I'm speaking a little bit more with my investor's hat, but with my sort of lawyer's mindset, if you like.
Mm-hmm.
In early stage investing, there isn't much to look at, unless you're talking about a deep tech company that's building and registering lots of registrable IP, patentable technology and that kind of thing, which in our region, we don't have a huge amount of. Typically what you're looking for is the company properly established? Is it licensed to do the activities that it's going to do? Does it have the right shareholding and corporate structure to facilitate investment by venture investors? Is the IP housed properly? And sometimes that's as simple as making sure that all of the staff have properly assigned the intellectual property they create as employees of the company to the company. So an investor coming in can say, yeah, company's properly organized, it's in good standing, its documents are right, the corporate structure is a good corporate structure for investors, and the IP is in the right place. And there's not that much more to look at in a seed stage company. But as an investor with a lawyer's mindset, or as a lawyer with an investor's mindset, whichever way around you want to look at it, I actually do like to look for red flags that are behavioral red flags early on. So I consider that to be a really important part of diligence in early stage companies. And it doesn't have to be something that takes a lot of time, but I will typically use a modified, simplified version of the due diligence questionnaire. Now, in M&A and private equity transactions, a due diligence questionnaire can be like 20 pages long and ask umpteen questions about every single aspect of the company's legal existence. I have a simplified version for early stage companies, but they do ask the founder certain questions about how the founder has structured the company, or how the founder keeps their data, or how the founder organizes themselves or conducts their operations, that are not necessarily legal questions, but they're questions designed to see how responsive and transparent the founder is in their dealings with the investor. And to me, that's actually really important, because how a founder conducts themselves is often a very good barometer of how they will conduct themselves in the future. So, I'm going to say something that favors people in my generation. The older founders, people that have spent a whole career in a corporate job or multiple corporate jobs, for example, when they approach that due diligence questionnaire, I had a company 3 or 4 years ago now, I sent them this questionnaire. What I got back was a PhD in, this is what our company looks like. This is how we've organized it. This is how we're managing all of these different aspects of the business, with an incredible amount of transparency, almost too much detail. But what you got from that was the sense of a founder really wanting to kind of engage with the investor and show the investor full kind of transparency. And as an investor at that time, I thought that was extremely positive. And the way that translates into what I'm seeing in my life as a lawyer in distressed situations down the line, just going back to your question, is that often the difference between success and failure in a company that gets to a distress point is the ability of the founder to maintain trust and confidence among their stakeholder community. And that's not just their investors, it's the team and the staff,
the customers.
It's the customers and the suppliers. It's like there's a whole bunch of people in that stakeholder community that you've got to manage in that situation. And transparency is a good conduit to maintaining trust and confidence. So as a seed stage investor, yes, I look for the psychological behaviors.
What are some other red flags that you've seen that maybe we can be mindful of?
So psychological or behavioral red flags, the lack of ability to listen, like that's a big one. Again, I've been doing this for years. I will sometimes have a conversation with someone or say something to someone just to test how much they're listening. Because for me, your ability to listen and synthesize what is entering your ear and supposedly going in your brain is a strong indicator of how you're going to behave now and in the future. And people who don't listen, like for me, I'm going to draw a line under that. That's not an opportunity.
There's those Instagram posters that you see sometimes, and one of them actually I really like, which is there's a reason why you have 2 ears and 1 mouth.
Yes. You know what? Yeah. My grandfather told me that when I was like 7 years old.
Yeah.
He said, "You've got 2 ears and 1 mouth. You should listen more. Listen more and talk less."
What other red flags?
So not listening. bullshit.
Okay.
So, I mean, like, some people actually believe their own bullshit, and some people think that other people will too.
Mm-hmm.
So, sorry for using a bad word, but I mean, it's like, having, first of all, saying that you're going to do something without demonstrating that you've either done it before or credibly that you're doing it now. I mean, just kind of, articulating a dream isn't enough. I think, having confidence is good, but there needs to be some credibility behind your confidence. There needs to be some credibility behind your single-mindedness. I mean, look, learnings that have disproven certain principles to me would include things like, don't ever invest in a single founder company, only invest in a company with co-founders. A lot of investors out there insist on having a co-founder and saying, we need that for whatever reason. But some of the most successful companies I've seen have a single founder or have like a single person sitting at the top of the pyramid. Usually that person, when they're successful, they've done it before. And usually that person knows how to be a CEO. And knowing how to be a CEO, by the way, isn't something that everybody knows the answer to.
Yeah.
A lot of people love the job title. They have no clue what it means. And so looking for signs that a CEO understands what their job is another one. And if they don't, then that's also a red flag. People who talk about how much traction they've got when they can't back it up the minute you start stress testing it. I mean, again, that's an obvious red flag, but it happens more often than not that people will say, I've done X and I've done Y and I have all this revenue and I have all these customers. And you think, wow, that's amazing. And as an investor, you might be tempted to just go, fantastic. Well, if those people are investing, then yeah, I'll invest too.
Yeah.
But I've worked with investors in this region that will sit in the data room of a company and actually look through its bank statements to verify the revenue numbers by actually matching it against money that's hitting the account. And that's something that a lot of people don't do. So, those are some examples.
Interesting. Yeah. I think I'd add to that probably if it's co-founders, I'd probably look at also the relationship between the co-founders. Like what are their respective roles, and if they're kind of, stepping on top of each other's toes, or if they have like a system of making decisions. You know what?
I have a great, do we have time I have a great story that fits directly with that point. And it was a company that failed, even though the company was a great company with a great co-founder team, really complementary personalities, both very talented individuals. One person, more the structured operational person, and one person more the kind of vision and the sales person. Both of them very good at the product, and it was a great product. The company hit a distress situation. They were doing well. They had navigated through the crisis of COVID really, really well. And then an investor that just wasn't behaving that well pulled out of the investment really late in the game after spending a lot of time looking at putting money into the company. And the company, just like the one we talked about earlier, suddenly found itself with no investor and like a month of cash or 2 months of cash. In that situation, what happened was that the sort of vision salesperson in the co-founder relationship became the more dominant person in terms of dealing with the stakeholder community. And the more sort of structured, rational operator person, not that the other one wasn't rational, but more vision and more passion, that co-founder stepped a little bit more into the background. And it was exactly the wrong thing to do.
Wow.
Yeah, it was exactly the wrong thing to do. What should have happened was the opposite, to sort of engage with the stakeholder community and build and maintain the trust and confidence of the stakeholder community probably could have been better achieved by the more structured and rational personality than the passion personality, who brought their passion to the crisis situation in a way that ultimately really set fire to the confidence of the stakeholder community, which was a shame. That could have been a company that could have been turned around.
I didn't expect that. I thought you were going to say it was actually the right decision. Okay, so Interesting.
So, I mean, look, it's an observation. I may be wrong about it. I was an investor in that
and
company.
what was it though? Is it like, what was it that person did that you felt set fire to the confidence of stakeholders?
I think it was basically presenting a narrative of what was going on that made the stakeholders, and probably particularly the investors, feel like they weren't necessarily being given full information or full transparency or full confidence that their interests were going to be looked after or were being looked after. And it's amazing how rapidly confidence can evaporate.
Yeah.
It's amazing. I mean, I've been involved as an investor and lawyer in multiple companies where that's happened.
Yeah.
There's another one.
And once it's done, it's done.
That's it. Once the confidence is gone, that's it.
This is what you told me, I think, when we were speaking earlier. You said that the difference between success and failure is entirely behavioral.
Yeah.
Right?
Yeah. Trust and confidence of your stakeholder community is like the blood pumping around a living body. If the artery is severed and the trust and confidence bleeds out, death is a natural consequence. Yeah. Sorry to use a graphic metaphor there, but that's 100% what happens time and time again. And as I said, I mean, there's another company I invested in where they built an amazing product, but the founder did not have a good go-to-market strategy, didn't have a good approach to establishing product market fit. It was a great product, which is, very much in demand, but it needs to be presented to the market and associated with other products in a way that makes it a successful product. And this founder was just incredibly stubborn, incredibly arrogant, didn't listen to anybody, and, ultimately lost the confidence of everybody. And, the same thing happened.
I think founders should hang out with you a lot more, because I think it's interesting to hear. I mean, we've just spoken about like 4 different failures now.
Yeah.
And I'm pretty sure there's a lot of that you don't necessarily hear about.
But there are plenty of success stories.
Yeah, absolutely.
Where the exact opposite happens.
Yeah, absolutely. No, but I'm saying that it's good to get this reality check to know that these things happen and understand why they happened, and potentially learn from other people's mistakes, basically.
You know what? Actually, we talked about Fetchr. That's the only one company that we've named in this conversation. That turnaround situation that happened with that small group of investors and the existing investors, the amount of maturity and rationality and confidence that was built among that group, the group that did the turnaround and the investor group that put the money, was extremely high. And the personalities involved in that played an absolutely vital role in that deal taking place. So the company that failed because of the 2 co-founders, the one that should have come forward and the one that probably should have been in the background, they had an enormously respected investor, former founder, enormously respected person in our ecosystem sitting on their board. And that person could have played a role, had they been allowed to play a role, in working with and assisting and mentoring and guiding the 2 personalities that ultimately were leading the business. So there's a lot of lost opportunity in these situations. I mean, another thing you were saying, founders should hang out more and talk about this. I mean, the composition of a board and how a board behaves also is really critical to this.
Yeah.
And I've worked with founders, some really awesome founders who are, they don't have to be pushovers. Actually, the successful founders are not pushovers. They're people who have backbone and personality and can back their own kind of vision of things, but who listen very carefully and adapt and respond to what is happening in a dynamic. A mature board with board members that are experienced and that have navigated difficult situations. So having former founders, by the way, on a board is really valuable. That can make all the difference, because your board is it's the key decision-making body in a company. So if you're bringing your board along with you on the journey, and you're taking and giving and compromising and learning, but also, demonstrating why they should have confidence in you as a founder or a founder team, is really critical. So all of those things are super valuable. I kind of feel like we were supposed to talk a lot more about law. The problem about law and lawyers is they make people fall asleep once they get into, the kind of weeds.
So this podcast would be a good before sleep listen then.
Exactly. But if anybody's thinking about applying for a job in my law firm, we do get extremely technical. We do talk about the details.
Okay, well, I think that was extremely helpful, just to talk about what's going on overall and what really causes some of the distress situations, and that they do happen. And I guess calm heads prevail, right? Or cool heads prevail.
Yeah.
Is that what they say?
Yeah.
I think there's a lot more to cover, Abdallah. So maybe you'll come back again. We can talk about the law. I mean, there's a lot of things I think that we can discuss on term sheets and convertibles and all these types of things that we can maybe discuss. Just before we wrap and have some rapid fire questions for you, two things. Is there like one piece of advice that you'd like to give founders or investors who are listening to this?
Yeah, one piece of advice to founders, I've already mentioned it in this conversation, but if all an investor is bringing you is cash, don't take the money.
Mm-hmm.
Look for people who are actually going to help you create value and who are going to bring something to you that's more than just cash.
Okay. How can people reach you?
How can people reach me?
So they can reach you on LinkedIn?
Yeah, I mean, the best way to reach me is to look me up on my law firm's website, taylorwessing.com, and find my number and email address. An email that comes to me will be picked up by me, or it'll be picked up by my PA and brought to my attention much more efficiently than a LinkedIn message. LinkedIn messages are the wrong way.
Yeah. Okay. So some rapid fire questions and we'll end. We're gonna try to get a bit creative here. So creating a playlist for a high stakes negotiation, what songs would you put on that playlist?
Oh, wow. What songs would I put on? Actually, I wouldn't have a playlist. There's an app that I use called Endel, Endel.
Okay.
And it has soundscapes for different things.
Interesting.
There's a sleep soundscape. There's a focus, deep focus, hibernation, energy restoration. I use it all the time. But there's a focus soundscape,
so
which I use when I want to get my head into preparing for something. I put it on and it's amazing.
Okay.
Yeah.
If you weren't a lawyer today, what else would you be?
Chef.
Okay.
If I could make as much money doing cooking as law, I would have always been a chef.
You could.
Or a fashion photographer. Like those are my dream
fashion photographer.
Yeah. So I'm really into photography.
Okay.
I do a lot of photography.
Okay.
And I like the
so
composition
like
and light.
Because fashion is like beautiful, right?
Yeah, I mean that's not the for me that's not the focus. The reason I like, I guess, the idea of doing fashion is because I think clothes are an incredibly creative way of people expressing their personality, and beautiful clothes on, good-looking people is definitely something I like looking at.
Okay. Name a book everyone should read.
Everyone should read. Oh my goodness. Well, I mean, Candide by Voltaire is one of my favorite all-time books. It's a novella by, 18th century French philosopher, and it's a work of political satire that talks about the dominance and ridiculousness of fanatical power, whether in religious or secular form. So it's a work of political satire, and I think satire is really important. So I read it when I was 16 years old, and I've probably read it every year since then. It's just a funny short novella. The Great War for Civilization in the Middle East by Robert Fisk, which is a deep study of our sort of recent last couple of 100 years of history in the region. And there's a whole bunch of others. Classics, George Orwell.
Okay.
The Crusades Through Arab Eyes by Amin Maalouf.
Okay.
If you're interested in our recent history and history that's pretty relevant to what's going on around us today, I think the history of the Crusades is something that not many people know about, and it's worth understanding.
Okay. One thing you could change in your clients?
Yeah, I wish I could make my clients understand that the value of lawyers is equal to, if not much greater than, the value of management consultants.
Okay.
Yeah, I think we add way more value, and it's much more substantive.
Okay. Just and finally, just one piece of advice for managing egos.
EQ. I mean, I think you've got to, if you're a person that is sitting in a landscape of egos, you've got to, work on your EQ and understanding what are the pressure points and trigger points, and how to empathize with the people whose egos are kind of dominating. Mm-hmm. Look, the ego, I've also done some reading on this topic, that the ego is a dimension of a personality that is incredibly important and helpful for a personality, because it drives a lot of positive aspects of a personality and how a person functions. So your ego has the ability to be your best friend and your worst enemy all at the same time. And so I think if you're a person that's managing egos or helping egos to kind of behave to their best potential, then understanding the personality is really important. So EQ.
Well, thank you so much, Abdallah. Such a pleasure to host you today.
Thanks, Lulu.
And hopefully we'll see you soon.
Yeah, absolutely. Thank you very much. Really appreciate it. Take care.
Thank you so much for tuning into this episode of Conversations with Lulu with my guest, Abdallah Mutawi. If you want to reach out to him, you have to visit taylorwessing.com. Make sure you visit conversationswithlulu.com to check out all the other episodes, and make sure you are subscribed wherever you're listening or watching the show. And do leave us a rating and a review. It does help in getting the show discovered. And if you have any comments about the episode or any feedback, please do reach out to me through the website Conversations with Lulu. Don't forget to share this episode with friends, family, colleagues, and whoever would benefit from this content.